The S&P 500 has just crossed the 7,000 mark for the first time in history. That's a monumental milestone that seemed almost unthinkable just a few years ago. But here's what's really fascinating about this rally. It's not being driven by broad participation across all sectors. Instead, it's being powered by what analysts are calling a $4 trillion boomerang effect from big tech companies. Think about that number for a moment. $4 trillion. That's the combined market value surge from just a handful of technology giants over the past year. And this concentration of gains is creating both incredible opportunities and significant risks for investors. Let's break down exactly what's happening. The S&P 500 is a market cap weighted index. That means the largest companies by market value have the biggest influence on its movement. Right now, the top 7 technology companies /U 2014, often referred to as the Magnificent 7 /U 2014, are carrying an outsized load. These include names like Apple, Microsoft, Alphabet, Amazon, NVIDIA, Meta, and Tesla. Their collective performance has been nothing short of spectacular. But it raises an important question. Can a market rally sustained by so few companies continue? The answer lies in understanding the forces behind this tech dominance. First, there's the artificial intelligence revolution. Companies like NVIDIA have seen their valuation skyrocket as demand for AI chips reaches unprecedented levels. But it's not just chip makers. Every major tech firm is racing to integrate AI into their products and services. Microsoft's partnership with OpenAI, Google's Gemini AI, Amazon's AWS AI tools /U 2014, these developments are creating massive revenue growth expectations. Investors are betting that AI will drive the next decade of profitability for these firms. Second, there's the resilience of their core businesses. Even as interest rates rose and economic uncertainty lingered, big tech companies demonstrated remarkable earnings power. Their balance sheets are strong, with massive cash reserves that allow them to invest through cycles. Their global reach provides diversification that many other sectors lack. And their subscription-based models /U 2014, think Microsoft 365, Amazon Prime, Apple services /U 2014 create predictable recurring revenue streams. This financial stability has made them safe havens during volatile times. Third, there's what some analysts call the flight to quality. With geopolitical tensions rising /U 2014, including concerns about conflicts in the Middle East that economists warn could have lasting impacts on the U.S. economy /U 2014, investors are seeking companies with proven track records and dominant market positions. Big tech fits that description perfectly. But this concentration creates vulnerabilities. When so much of the market's gains come from so few stocks, any stumble in the tech sector could have disproportionate effects. We've seen hints of this already. Tesla's recent robotaxi announcement, which some critics have called a potential stock pump ahead of earnings, shows how individual company news can create volatility. Similarly, Goldman Sachs recently issued blunt words for Amazon stock investors after a big deal, reminding everyone that even giants face challenges. The broader market implications are significant. As big tech stocks rise, they pull up the entire S&P 500 index. This creates a perception of broad market health that might not reflect reality in other sectors. Energy companies, for instance, face different challenges. Financial stocks are dealing with interest rate uncertainty. Consumer discretionary spending shows signs of strain. Yet the S&P 500 keeps hitting new highs because of tech's overwhelming influence. This dynamic also affects investment strategies. Passive index funds that track the S&P 500 are becoming increasingly concentrated in tech stocks by default. Investors who think they're getting diversified exposure might actually have heavier tech exposure than they realize. This isn't necessarily bad /U 2014. Tech has been the best performing sector for years /U 2014, but it does create concentration risk. Looking ahead, several factors will determine whether this rally can continue. Earnings reports will be crucial. If big tech companies can deliver on the high expectations priced into their stocks, the rally could sustain itself. but any disappointments could trigger significant pullbacks. Regulatory scrutiny is another factor. Antitrust concerns have been growing, and any major regulatory action could impact these companies' growth trajectories. Competition is intensifying too. The news about Google and Marvel being in AI chip talks as NVIDIA competition heats up shows how quickly the landscape can shift. Even dominant players must keep innovating to maintain their positions. Then there's the macroeconomic environment. Interest rate decisions by the Federal Reserve, inflation trends, and global economic conditions will all play roles. The impact of conflicts like the one in Iran, which economists warn could hurt the U.S. even after hostilities end, adds another layer of uncertainty. For individual investors, this environment requires careful navigation. Chasing the hottest tech stocks might seem tempting, but understanding valuation is more important than ever. Some tech stocks are trading at historically high price-to-earnings ratios. Others might have more reasonable valuations relative to their growth prospects. Diversification remains a fundamental principle, even when one sector is outperforming. Consider what happened during the dot-com bubble. Technology stocks drove the market to incredible heights before the bubble burst. The current situation is different in many ways. /2014 Today's tech companies have real profits and sustainable business models. /2014, but the concentration risk echoes some familiar patterns. Meanwhile, other trends are developing that could eventually challenge tech's dominance. The transition to renewable energy is creating opportunities in sectors like battery technology. Bloomberg reports that cheap batteries are taking over the world's power grids, which could lead to massive infrastructure investments. Space exploration is another frontier, with speculation about a potential SpaceX IPO. /2014, though reports about which cryptocurrencies might benefit should be approached with extreme skepticism, as such claims often lack substance. The key takeaway is this. The S&P 500's breakthrough past 7,000 is a historic moment driven primarily by big tech's extraordinary performance. This $4 trillion boomerang effect has lifted the entire market, but has also created unprecedented concentration. Investors should celebrate the milestone while remaining aware of the risks that come with such narrow leadership. The coming months will test whether this rally can broaden to include more sectors or whether it remains dependent on a handful of technology giants. Either way, understanding these dynamics is essential for making informed investment decisions in today's complex market environment. This video is for educational purposes only and not financial advice.